Bismillah ar-Rahman ar-Rahim. Adequate financial planning is a key element in the success of any business venture. Conversely, we can say the lack of adequate financial planning is often a key element in the failure of many business enterprises. In this lecture, we will examine how to do budgeting and financial planning. The budgeting process. Let's look at the budgeting process. The budgeting process starts with the management objectives, and the first thing to do is sales budget. The management look at what are their objectives, what is the strategic plan, and what objectives they are going to achieve, and according to that they forecast the sales. And so sales budget is done, forecast of quantities sold, and forecasting of the dollar income, and forecast of other income. So this will set the limit, that how much we are going to generate the revenue. Then we have the production budget, which is how much expenditures will be there. So revenue minus expenditures. We have a production budget, units to be produced, cost of material, direct labor cost, factory overheads. So this will give us the cost of goods sold. And then we have the marketing budget, promotional costs, selling expenses by territories, etc. And then some other budgets like administrative and expense budgets, miscellaneous expense budgets, etc. This will result in financial budgets, budgeted balance sheet, and some supporting budgets. Financial planning. It's a continuous process of directing and allocating financial resources to meet strategic goals and objectives. So the first thing is this, that this financial planning is allocating the financial resources to meet strategic goals and objectives. The output from financial planning takes the form of budgets, widely in the form of pro forma or budgeted financial statements. Budgeted financial statements is about the forecasted financial statements. Budgeted financial statements is based on detailed budgets, and detailed budgets include sales forecast, production forecast, and other estimates in support of the financial plan. Collectively, all these budgets are referred to as the master budget. Financial planning can be broken down into planning for operations and planning for financing. Operating people focus on sales and production, while financial planners are interested in how to finance the operations. Therefore, we can have an operating plan and a financial plan. To keep things simple, we will consider financial planning as one single process that encompasses both operations and financing. Start with strategic planning. Financial planning should be linked to strategic planning. This is very important. The strategic planning may be that many of the organizations have multi-businesses. They are called strategic business units, and they may have strategies for each business unit. Like some they have renewal business strategy, another may have some growth strategy, another business may have some stability strategy, etc. And within the businesses, They may have strategies like cost leadership strategy or differentiation strategy or focus strategy, etc. So the financial planning should be linked to strategic planning. Now what you want to achieve. What is, for example, cost leadership strategy? You want to be cost effective. You have to cut the cost from every operation and so on. So that financial planning should be linked to the strategic plan, the plan which what you want to do, or there is a differentiation strategy, etc. Failure to link and connect budgeting with strategic plan can result in budgets that are dead on arrival. Strategic planning based on a very thorough assessment of the organization and the external environment involves developing a mission statement that captures why the organization exists and plans for how the organization will thrive in the future. Strategic planning is, you plan according to seeing what is the environment, external environment, and how this external environment will affect the organization, and then you develop the mission statement. This external environment, you are looking at, for example, competitors, you are looking at technological changes, you are looking at what would be the economy in the coming years and so on. All these factors are looked at, and then you develop a mission statement that captures why the organization exists, and of course you develop the objectives and goals for the organization. Strategic plans are implemented by developing an operating or action plan. Of course, strategic planning is done at long-term planning. It is a long-term planning, and operational planning is try to achieve those strategic goals. Within this operating plan, we will include a complete set of financial plans or budgets. So the first thing is the sales forecast. Developing a budget starts with forecast that drives much of financial activity, named sales. Sales will set the total limit or set what we are going to achieve, and that will tell us how much revenue we will be generating. Several factors should be considered for making a sales forecast. Of course, there are several factors when making the forecast. Demographics are looked at, competitors are looked at, any technological changes or new regulation, government regulations, etc., which can affect the sales. All these things can be are looked at, and then the sales forecast is made. A sales forecast has to take into account that what we expect to sell at what sales price, and this estimate will be used for several other estimates in our budgets. So we'll see that how much we are going to sell and at what price. This will tell us how much revenue we are going to generate, and then of course if this much we are going to sell, then how much material is needed, or how much labor is needed, etc. This all will be coming from there. Then we will start with an example of sales forecast of a company which is making leather shoes, and let's say it is forecasting 16,000 pair of shoes to sell at the price of $45, and this will be the total sales or total revenue will be $720,000. Several details budget developed for developing a budgeted income statement. Remember that our objective is to make a budgeted income statement and then budgeted balance sheet. So several detailed budgets have to be developed before we make the budgeted income statement. For example, production must be planned for our estimated sales of 16,000 units from Exhibit 1. We said that 16,000 units we are going to sell. The production department will need to budget for material, labor, and overhead based on what we expect to sell and what we expect in inventory. So material cost, labor cost, and overhead costs are the cost of goods sold, and this is the major expenditure in making the products. So we have the Exhibit 2 over here, a production budget. We say that the planned sales are 16,000. Okay, let's say this is the ending inventory we want at the end of the period, if it is 1 year, let's say. So this is the ending inventory we want, and this is the finished inventory, finished product. Okay, we remember that we can keep the inventory as raw material or work in progress or a finished product. So this is a finished product and ending inventory. Total units are 17,500. Then if we have 16,000 planned sales and 1,500 we want at the end as an ending inventory, then 17,500, but we may have some beginning inventory there also. So the planned production is this is less beginning inventory, then the planned production will be 14,500. These are the number of units or number of pair of shoes we have to make or produce. After establishing level of production, Exhibit 2, we can prepare a material budget. The materials budget attempts to forecast the level of purchases required, taking into account materials required for production and inventory levels. We can summarize material to be purchased as material purchased is equal to material required plus ending inventory and beginning inventory. Remember, now we are talking about raw material inventory. So we may have some inventory, we are keeping inventory as raw material, and we are keeping some inventory perhaps as work in progress, and some inventory we talked about as a finished product. So here is the material budget coming. Lace shoes require 0.25 square meter of leather, and leather is estimated to cost $5 per square meter. And the material required then is, we have said that 14,500 pair of shoes we have to make. Then we need of course how much leather is needed is multiplied by 0.25 square meter, and we get 3,625 square meter of leather we have to buy. So material required for production is 3,625 square meter, and the desired inventory, we want to keep some leather as an inventory at the end, 375, and then the total material required is 4,000, summation of that, less some beginning inventory. We may have some beginning inventory as well, so some leather which is coming from the previous year, and the total material required is then 3,500 square meter. The unit cost of material is $5, and then what we have is total material purchased is going to be $17,500. So let us work on this OneNote to see all the exhibit on one page. We started with the sales forecast, and then we we said that we will be able to sell 16,000 is our forecast here at the price of $45, and we will have the total sales as $20,000. Then for 16,000 pair of shoes, we said that the finished product or finished lace shoes, we want to have some inventory of them is 1,500. Then the total unit is 17,500, and the beginning inventory we said is 3,000. Then the planned production is 14,500. And then we looked at the material budget, and we have assumed that the lace shoes require 0.25 square meter of leather, and it cost per square meter is $5 per square meter. Then we need 14,500 is the total production, multiplied by 0.25 is per square meter. 0.25 square meter is required for each pair of shoes, so we need 3625 square meters. And then we have the material required for production. We said that this is the 3625 square meter coming from multiplying with 14,500 with 0.25, we get 3625 square meter. And let's say we have the desired ending inventory is 375, and this is a material inventory, raw material inventory, and the total material is then 4,000, and we may have a beginning inventory of 500. Then the total material required is 3,500. And then you multiply it with the unit cost for material, which is $5, and we get $17,500. The next thing is when we have material budget, we want to make the labor budget. We need to forecast our labor needs based on expected production. The labor budget arrives at expected labor cost by applying an expected labor rate to required labor hours. So here we have the exhibit 4 showing the labor budget. Lace shoes require, let's say, 0.5 hours to produce 1 unit. Then 14,500 units we said is the total production here with 14,500. So 14,500 units multiplied by 0.5 hours. So we need 7,250 hours of labor to produce this much of units. And the expected hourly labor rate is for next year is, let's say, is $12. Then the estimated production hours is 7,250 multiplied by the rate 12, and we get the total labor cost 8,700. Now, as production moves up or down, support services and other costs related to production will also change. These overhead costs represents the major cost. These are the overhead costs, and they represents the third major cost of production. Remember that in cost of goods sold there are 3 major items. What are these? The material cost, the labor cost, and the overhead cost. So this is our overhead budget. It estimated for each line item as follows. Indirect labor cost. Indirect labor cost may be the production, supervision, and inspection. Let's say it is 12,000. Utilities are 5,000. Depreciation is 3,000. The maintenance is 1,000, and insurance and taxes is, let's say, 4,000. This is our total overhead costs. This is an estimate, of course. Once production cost, which includes direct material, direct labor, and overhead, have been budgeted, we can work these numbers into our beginning inventory levels for direct material, work in progress, and finished inventory. Beginning inventory levels are actual amounts from the last reporting period. We need to apply our cost based on what we want ending inventory to be. The end result is a budget for cost of goods sold, which we will use for our forecasted income statement. So here we have the cost of goods sold. We start with the beginning inventory. Okay, in the cost of goods sold, we have the direct material. Okay, the direct material is there, and we may have inventory in work in progress, and of course inventory is finished inventory. We look at the direct material costs. We already have actually worked out. We know that we require the material required is to sell 14,500 pairs of shoes. We can simply say is 3625 square meter. So 3625 square meter multiplied with 3625 square meter multiply by 5, and it will give us the 18,125. We are starting, actually we start with beginning inventory 2,500. Beginning inventory is 500, right? So 500 multiplied by 5, here is the beginning inventory, 500. So 500 multiplied by 5 is 2,500. Okay, and then the purchases we have said is 17,500. Ending inventory is 375. Here desired ending inventory is 375. So 375 multiplied by 5 is actually 1875 here. And then of course if we sum this up, it is the 18,125. It is indirect way of saying the same thing which I said, that 3625 square meters of leather is required, multiplied by 5, and we get 18,125. So same thing. And then we have worked out the direct labor, exhibit 4, which is 87,000 for 14,500 pairs of shoes. This is our direct labor cost here. And then overhead cost is 25,000. So the total manufacturing cost is then these three items here: material required, direct labor, and the overhead costs. So what we get is 130,125. This is the total manufacturing cost. And then we take this to work in progress. We may have some semi-finished products, like for example the soles have been prepared, and then this is, let's say, is $16,000 is the beginning inventory for that. This is the assumption here, because inventory can be kept as work in progress also. And then the total work in progress is this much, which is 130,125 plus 16,000. We get maybe less inventory, we want to keep it at the end, so this is 12,000. The cost of good manufacture is then $134,125. Then we move to the finished inventory. Finished inventory, we have, let's say, the beginning inventory cost was production cost was 46,000 of the beginning inventory. Remember that the beginning inventory we had this some beginning inventory finished was 3,000. So let's say this is $46,000 cost is there for that. And then we have 134,000 coming from the second column or third column, and then the cost of goods sold available to us is then summation of this finished inventory, which is the beginning inventory of that finished product, beginning inventory, plus the cost of good manufactured. We get 180,125, and we want to keep some ending inventory, that is $36,000 worth of that we want to keep it. So the cost of goods sold is then $144,125. So once we have finished the production budget, which was we found out the cost of goods sold budget, and then we may have some other budgets like marketing budget and general and administrative budget. So let's look at the marketing budget. Estimated for each line item for the marketing department, we may have marketing personnel salaries, advertising and promotion, marketing research, travel and personal expenses, expenses and so on. And the total marketing expenses is, let's say, is $135,500. Similarly, we have general and administrative expenses. These are the budget for that. This is again estimated for each line item per department managers, management personnel, their salaries, accounting personnel salaries, legal personnel, technology personnel, rent and utilities, supplies, miscellaneous, etc., and the total general and administrative expenses are here. Finally, we are ready for budgeted income statement. We can look at this. We started with the revenues. Exhibit 1, $720,000 we said that we will be able to sell, and this is the revenue we will generate. Less cost of goods sold, we have Exhibit 4, which is $144,125. So this is the cost of goods sold budget. And then gross profit or gross margin is then $575,000. This revenue minus cost of goods sold is give us the gross margin. Less marketing, we have marketing expenses $135,000, and then we have some general and administrative expenses. Exhibit 8 is there, so this is $297,500. This will give us the operating income, which is, we can say, is earning before interest and tax. That is our operating income, earning EBIT, and then we pay interest on that. Let's say we pay interest of $8,000, or we are expected to pay, and then income before taxes will be this much, and then we have to pay tax 37.5%, let's say, and we are left with this net income. So this is a budgeted income statement. This is not the actual, but it is a forecast one, the budgeted income statement. Now that we have a budgeted income statement, we can prepare a budgeted balance sheet. The budgeted balance sheet will provide us with an estimate of how much external financing is required to support our estimated sales. The main link between the income statement and the balance sheet is retained earnings. Therefore, preparation of the budgeted balance sheet starts with an estimate of the ending balance for retained earnings. In order to estimate ending retained earnings, we need to project future dividends based on current dividend policies and what management expects to pay in the next planning period. So, and here is the estimated retained earnings exhibit. Let's say we have a beginning balance of $270,000, and the budgeted income, net income from exhibit 9, we have $84,297. Then let's estimate dividends. Let's say we give dividends to the shareholders, $55,000. Then our ending retained earnings is $299,297. This is the cumulative retained earnings. This is in the part of balance sheet. Next, we need to account for the acquisition of fixed assets. As the business depletes its asset base, it must reinvest to sustain assets which are the basis for generating revenues. For example, do we need to purchase new machinery or computer equipment? Do we plan to expand our production facilities? Operating personnel and upper level management will decide on future capital spending. Future capital expenditures are summarized on capital expenditure budget. So let's say we have this we purchased some new office equipment of $16,000. This is estimate that we will purchase this one, and we will also replace the leather cutting machine, $8,500. So the total capital expenditure is to $24,500. Based on the beginning balance in assets and the budget for capital assets, which is exhibit 11 over here, we can estimate an ending asset balance for the budgeted balance sheet. So we can have another budget for the fixed assets. We may have a beginning balance of $55,500, and there is a new acquisition of $24,500, which is coming from exhibit 11, the capital expenditure budget, and then minus some depreciation for the year, $3,000. So the ending fixed assets are $877,000. Now we are ready for preparing the budgeted balance sheet. We will assume that liabilities and interest expense will remain the same. However, after we have determined our level of external financing, we will need to revise these amounts. Since the balance sheet is a year-end estimate, it assumes that all other estimates have been met. In a world of rapid change, annual forecasts are rarely close. Therefore, we will simplify our preparation of the budgeted balance sheet by relying on relationships. Stable relationships over the last 5 years are particularly helpful. The budgeted balance sheet will show either a surplus, excess financing over assets, or a deficit, additional financing required to cover assets. This difference is derived from the accounting equation that assets is equal to liabilities plus equity. So here we have our budgeted balance sheet showing we have cash of $36,000, this is an estimate again of 5% of sales. These are some stable relationships, we can say that. Accounts receivable, 12% of sales. Okay. Then we have inventory, 7% of sales. And then prepaid expenses, 5-year trend analysis is there, 11,000. Fixed assets, which is coming from Exhibit 12, 877,000. So the total assets are 1,060,800. On the liabilities and equity side, we have accounts payable, 79,200, which is again coming from some stable relationships of past 5 years, 11% of sales, we can say that. Current portion of long-term debt is 6,000, which is also a current account, we can say current liability. And then the long-term debt is 60,000, which is subject to revision. If we are going to borrow more, then of course this will be changing. The total liabilities are the sum of current liabilities and the long-term debt. We have 145,200. Common stock, let's say, is unchanged. We don't sell any new. We're not going to sell any new common stock. The retained earning is coming from the Exhibit 10, retained earning statements, and then the total equity is 749,297, which is the summation of common stock plus the retained earning. This is the total equity. And total liabilities and equity is then summation of equity plus liabilities. We have the total liabilities and equity. Now we have shown assets as 1 million and liabilities and equities as 894,000. Then there is a difference here, which means that we need external financing, and that external financing is 166,303, because if you subtract from the assets minus the liabilities and equity, this is the total financing required, which may be then either we have to sell the common stocks to meet the buy those assets and so on, keep the requirement, and or we may have to borrow some more money, etc. According to this, we are not going to sell any stocks because we say unchanged. We might have this, we are saying subject to revision, so we might have to sell more bonds or get some more loans, etc., and that will be how we are going to finance that. So we continue with budgeted financial statement. To support the budgeted financial statements, a capital addition budget is prepared. After preparing budgeted financial statement, it is very important to carefully review these statements with management. For example, can we truly expect to raise 166,303 in capital as indicated in Exhibit 13 of our budgeted balance sheet? Will the budgeted financial statement meet the expectations of shareholders? Several critical questions must be asked before finalizing the budgeted financial statements. Budgets are prepared on an annual basis, but many unplanned events can take place during the year, making annual budgets extremely inaccurate. Therefore, financial planning is often improved by simply forecasting on a monthly or quarterly basis as opposed to an annual basis. Sometimes the organizations, they not only make a budget for fixed sales, but they make hypothetical variable budget. Not hypothetical, they make variable budgets. So here we are showing a hypothetical variable budget in which we are not fixing the output units. Let's say we may have this is our expected sales, but then, and according to that we will prepare the budget, but then we will have several other budgets which are which we think that the output or the sales we are assuming will not be the same what we forecasted. So we may have some variations in there, and we prepare the budgets for these different forecasts. So here we have, for example, we can have a forecast for 1400 units, we can have a forecast of 1600 units, or what we are, if we are not able to sell 1200 but only 1000. And then the budgets will be, of course, changing accordingly. Let's say sales will be according to at Real 5 per unit. So this is the sales coming here. And then we have the variable cost is, let's say, is 3 reals per unit. Then it will be according to how many number of units we are selling, 3000 or 3600 if we are selling 1200 units, and so on. The fixed costs, it remains fixed. So whether we sell 1000 units or 1200 units or 1400 units or 16, this is fixed cost, and that makes change the budgets. It's not a linear relationship then, because of that the fixed cost is fixed, and then the total costs are then the summation of variable cost and fixed cost, and then the planned profit is, of course, the sales minus the expenditures. So this is just an example of a hypothetical variable budget that the organization make also not only one budgeted one budget, but they may have variations. And of course this is very easy to change. If you have something in the Excel file, all these budgets will just to change, you just have to change the output, and you will have all the things automatically will be updated. So that's not a difficult thing. Variable budgeting takes into consideration that the actual output can deviate from planned output. All supporting budgets should also vary based on the output. And then some organizations, they make moving budgeting. It is the preparation of a budget for a fixed period of 1 year with periodic updating for fixed intervals at 1 month. Let's say we prepared a budget from January to December, and then when January has passed, then the new budget will be prepared from February till next year January, and so on. So this is called a moving budgets. The cash budget. A good example of short-term financial planning is the cash budget. The cash budget is an estimate of future cash inflows and outflows. Cash budgets are often included with the budgeted balance sheet. However, it should be noted that cash budgets are not widely used as a general forecasting tool, since they are specific to one account, namely cash. Instead, cash budgets are often used by cash managers and treasury personnel for managing cash. Here is a summary of the budgeting process we discussed. We started our budgeting process by looking at strategic planning. Strategic planning should always be the starting point for financial planning, and from the strategic plan we develop a plan of action so we can implement the strategic plan. This is often called an operating plan or operational plan. With the operating plan, we can include a set of budgets for successful implementation of the strategic plan. The entire set of budgets can be categorized as follows. We have a master budget which includes the operating plan and the financial plan. The operating plans is the sales forecast, exhibit 1 we have shown you, then the budgeted production, exhibit 2, then budgeted production cost, exhibit 3 to 5, and then the budgeted cost of goods sold, exhibit 6, budgeted operating expenses, other expenses like marketing and other expenditures, marketing and sales, administration, etc. Budgeted income statement is exhibit 9. And then on the financial plan we have budgeted retained earnings, exhibit 10, budgeted capital expenditure, change in fixed assets, and budgeted balance sheet. And they may have cash budget as well. The challenge is to make financial planning a value-added activity that helps the organization achieve its strategic goals and objectives.